The Mag 7 have taken quite a hit in the past few days as we are seeing kind of this crazy movements happening in the tech space. I mean, Tesla right now is down roughly 53% from its overall highs. We have Nvidia down roughly 28%. Now, in today's episode, what I want to do is the following. First, I just want to take a closer look at some of the valuations of all the valuations of the Mag 7, see which ones are still trading above average. Maybe some are trading below. And I also want to share three of my favorite Mag 7s right now, and the ones that I would be willing to buy and add more to my overall exposure. Obviously, if you are familiar with this channel, I'm pretty sure you can guess number one, which is Nvidia. But let me know in the comments below if you can guess the other two. Again, this is mainly focused on the overall AI investment thesis, and I do believe these two players can benefit dramatically from AI innovation. And before we get started, if you want to learn more about the semiconductor market, make sure to check out my free daily semiconductor newsletter, whatthechipHappened.com. The link is down below.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so first, let's take a closer look at price action, because obviously if we look at prices off the high, everything seems pretty scary. But I wanted to kind of compare these stocks and see how they've done with the overall market, the S&P 500. So Tesla in the past year is still up over 26%. Nvidia is still up over 22%. Amazon up over 11%. Google up over 22, Meta Platforms up over 18, and Apple up over 33. Now, 6 out of the 7 Mag 7 have all outperformed the S&P 500. Now, I am curious to see how they do compare with the Qs, and they actually all have outperformed the Qs as well. The only one that has not outperformed either of the markets has been Microsoft. That one is the only one on a yearly basis to be down roughly 6.4%. Now that we kind of seen this, I also want to take a closer look at the differences from their all-time highs in the past year. And we can see Tesla is the one that has taken the biggest hit and is down roughly 53%. So obviously, if you bought in early last year, you're still pretty green in a lot of these stocks. If you bought at the peak, you're down a nice amount. Tesla down 53%, Nvidia down roughly 29%, Amazon down nearly 20%, same with Alphabet, Meta and Microsoft down roughly 19%, and Apple down roughly 12%. So if I was to say one of my least favorite in the Mag 7 is Apple, and I'm pretty sure we do have a lot of bearish people for Apple, bullish people for Apple, but I do believe this is a company that's not innovating quickly enough, that this is a company that I feel doesn't have much growth opportunity except squeezing out money from things like its overall app store and squeezing from the consumers with refresh of their phones, of their whatever other types of products and accessories they have, but no real innovation. So obviously you can see I have this huge kind of bearish hatred towards Apple. But I kind of want to look at them also in forward PE ratios. So even though Tesla is the one that has taken the biggest hit, this is also still the most expensive with forward PE ratio sitting at 77. Now it is important that these forward PE ratios are PE ratios for this upcoming fiscal year to end. And not everybody follows the calendar year. I know, for example, Microsoft is about 2 quarters ahead, so their forward PE ratio might seem a little bit more expensive than others when comparing in the same timeline. But we can see Apple at 31, pretty expensive. Again, I'm not sure why Apple is worth that valuation. Amazon 30, Microsoft 28, Nvidia 23, Meta Platforms 23, and Alphabet at 18. So I am very excited, as we're going to see, for Nvidia with a forward PE ratio of 23.78. And the second one that I am very excited we're going to see is Alphabet. And later in this episode, I am going to share kind of some of the top level overview of why I am bullish in this space. Apple, what we saw it down double digits still, its forward PE ratio is still trading above its average. So I personally do believe that Apple is one that I really wouldn't buy at these levels and wouldn't really want to add on anytime soon, as it is trading still more expensive than its overall average, even though, like I mentioned, I don't think it has done much in forms of innovations. Now, Meta Platforms is one that is trading pretty cheap, right? Pretty cheap in those low 23s. I think it was like the third cheapest, only behind Nvidia and Google, but still, Meta Platforms is one that again has seen this nice, crazy price action in the past few weeks, in the past few months. And it is definitely because of their overall investments in AI, their overall efficiency in advertisement, and their overall exposure with things like Llama, and the future that this could bring for the company. But regardless, this one is also trading above its PE forward ratio average. So I think these are the only two players, Apple and Meta, that are trading above the average. Now, Amazon's average is roughly 39.85 and is currently trading far below that at 30.76. So if one was to tell me, Jose, I wouldn't mind buying Amazon at these levels, I wouldn't argue with them. Obviously, I would never argue with anyone making any forms of investment thesis, but Amazon has various growth opportunities from their advertisement, obviously a huge play in the robotic space, obviously a huge market player here in the e-commerce space, and in the AI space with things like with innovative Alexa, with the cloud market, and the kind of cloud infrastructure solutions that they have, this is definitely one that can benefit from it. So Amazon, while it is not in the three that I have, it would probably have made number four. Now Tesla's PE forward ratio is trading a little bit below its average. And this is me personally. I'd like to look more at the average opposed to just having a fixed number. I know many people say, I wouldn't buy a stock with the forward PE ratio above X, Y, Z. I personally just, one, enjoy finding a company that I enjoy their overall growth opportunities, their bullish thesis, the products that they have. And then if those theses match my overall trend buying, then I would look at things like forward PE ratios and see how they're trading compared to historical levels, right? So we are seeing now Tesla being cheaper than its average, and Tesla is one of those other three. So I mentioned already Google, I mentioned Nvidia, and the third one is Tesla that I wouldn't mind adding onto these levels. I also wanted to kind of show Microsoft's PE ratio forward is on average 30.45 right now. It is trading below that at 28.84. Nvidia, one of my favorites, average usually trades around 35, and right now is trading at 23.78. This, in my opinion, is trading at extremely cheap values. But again, with Nvidia, this is completely dependent in the AI market. Now, it is very rare for me saying that I personally would buy NVIDIA because NVIDIA is already a massive position in my overall portfolio. But at these valuations, I wouldn't mind adding more to my exposure. Now, the other one is Alphabet, and Alphabet right now is trading at forward PE ratios of 18.6. This is actually below its average of 20.77. Now, I mentioned for each stock, I have kind of like a very top level overview of growth opportunity. So with with Alphabet, my biggest growth opportunity for them is the cloud growth. So in the cloud growth this fourth quarter, they grew about 30%. And they mentioned that the main reason is they are still seeing strong demand from their customers, but they didn't have the capacity to match that demand. And they ended the year with more demand than supply. So this is something we're hearing from all the big tech players and from the cloud infrastructure. So you might be saying, Jose, why are you giving Alphabet a bigger opportunity here where this can be said for Amazon and it could be said for Microsoft? I think the big thing for here is Google, Alphabet is actually really good at building infrastructure. They actually also have a very strong AI chip that they use for internal workloads. And as AI models continue to grow, as the demand for their Gemini API and their Gemini producing token market continues to grow, as more developers use Gemini, I think that internal chip and that internal infrastructure is gonna play very crucial role in the overall growth. I think Alphabet is actually going to grow its market share a lot faster than Microsoft and Amazon in the upcoming quarters. And mainly because one, it's buying a lot of NVIDIA GPUs, but secondly, it has a very strong internal AI chip that can help with the advancements of its overall infrastructure. Now, the second one we're going to look at is Nvidia. My bullish reason here is I do believe we are in early innings of AI. Again, if you are not bullish in the AI market, then maybe these stocks aren't for you. But in a recent Morgan Stanley conference that happened a few days ago, the CFO of Nvidia mentions that one of the biggest issues and statements happening is questioning Nvidia if we are at a peak. Are we at a peak of what we're going to see with AI? And Colette mentions knowing that the install base of general purpose computing needs to be transformed into accelerated computing just to manage the significant amount of data, but also to deal with the needs for AI and what AI will be for us in the next decade. Absolutely not. Is there still growth coming in front of them? Colette mentions absolutely. So I do believe the AI market is still very much in early innings. And if you want to hear more about what Colette and the CFO of NVIDIA said about the overall AI space, make sure to check out yesterday's video where I did a whole deep dive on this conference. Now, the final one is going to be Tesla. And Tesla is one that trades at very, very expensive ratios. And obviously, this is seeing a lot of volatility with things that Elon Musk might be doing with other places and other kind of businesses, being Doge, the XAI, and so on and so forth. But Elon Musk in the last earnings believes that Tesla is in a path where it's worth, that is in a path that it could lead to Tesla be worth more than the next top 5 companies combined. Obviously, it is going to be a difficult path, but it is an achievable path. So first, I wouldn't take what Elon says in forms of timeline or valuations to a true truth, but it gives me a positive reinforcement that there is still massive growth ahead. And they mentioned that they made critical investments in 2024 in manufacturing, AI, and robotics that will bear immense fruits in the future. Now, Tesla believes that they are going to do really good due to autonomous vehicles and autonomous humanoid robots. But unfortunately, the market is still expected to be very weak in 2025. So they're giving expectations for an epic 2026 and a ridiculous 27 and 28. So I do own a Tesla, and as an engineer, I can appreciate the advancements and the innovation that has gone with FSD. And I think this is a big opportunity for them in the future. Now, I also believe that a lot of what they're learning here in the autonomous space can transfer over into the robotics. Not a true transformation, but at least kind of the some top level thinking, some of the compute power, some of the training can transfer over to the humanoid robots. And Tesla being a huge, huge manufacturing player, they do have that kind of advancements in the innovation and the future consumer product push of humanoid robots. So Tesla is one of those companies that from a top level view, as an engineer, I can see this innovation progressing further. Now, the real question is when is that going to happen? And Tesla for me is going to be a stock that continues to trade at very high valuations. And this is a stock that within the next year or so, I wouldn't really expect much, maybe a lot of volatility, but in forms of business, not much growth. And we have to continue to see AI innovating for them to see even more and more innovative push in their core technologies. So those are my top 3 Max 7. And again, most of the reasons have to do with AI. And I do believe AI is going to help all 3 companies continue to grow. And that is why I am very, very excited for the future of tech. Now, in the short term, obviously stock prices can continue to go down. I'm not going to deny it. Tomorrow, these stock prices can drop down. But as a long-term investor, I believe the current valuations within the next 3 to 5 years are going to be one of my best investments in a long time.